Happy Monday, everybody. This is your trucking market update, and I'm trying something new today, so bear with me and let me know in the comments if you like it. But there's been a lot of commentary and some direct messages on where I pull my data from, who I'm hearing these things from, and where I'm really getting these updates from. And what I want to share is one of my major resources that I've explained before, the FTR Group. They are a market intelligence specifically for transportation data, and they release this every week. So we'll dive into it right now. I'd love to give you a little glimpse, a sneak peek. I'll minimize my face here, get that out of the way. Okay, let's scroll up to the top, and most importantly, let's start with transportation truck revenue. So when you think about your mega carriers, this is huge. This is 7 or 12% year over year change negatively. So that's negative 12% change. And when we look at how that affects general freight trucking revenues, it's upwards of minus 19%. And for long distance, almost the same. And you're looking at the gray bars are the year over year change prior to the previous year. But the specialized trucking revenue hasn't been hit as much. Something to note. So I use that statement to preface just the impact that you're going to see with diesel, but more importantly, with our spot market conditions. Now, as you all know, if you've been attuned to the channel, and please share this with your friends, leave some commentary below, and share and save this for later because you will want to reference this. But the spot market, so if you look at total spot loads for week 36, we did hit the typical dip. And when you look at this, the blue bars are 2023, current year. The reddish orange is last year. Green is 21. And the dotted line is the rough 5-year average. So as you can see, 2023, we are below, from a total spot load perspective, way below the 5-year average. But we are still following the general trends. And that's very close to the spot market rates. Now, we did go above the 5-year trend for total spot rates. This is not specialized to any dry van, reefer, or flatbed. So when you look at it, we are dipping under over the last, let's say, 10, 12 weeks underneath the 5-year average, and we are kind of going against the grain of the pattern here. So we'll be on lookout over the next few weeks on what's this to come. But you can see that in weeks 50 through 52, we hit that seasonal spike, which will happen. Now, when you look at spot rates by equipment, they're following the general ebbs and flows, except you see flatbed kind of tick up here right in 2022. Now, that was definitely not planned, but it was crashing now. So we're seeing over the last month and a half, flatbeds have absolutely just been obliterated on the spot market. So when you look at the dry van spot loads, you see that following the trend line here, we're dipping in week 36, and that's causing a spike for some reason. Now, when you look at it, it's following the trends here. And when we look at the 5-year trend average, it's very accurate. So it's going to tail off here and be very flat for the remainder of the year with some ticks up at the last, let's say, 6-7 weeks. Refrigerated lows, it's very sporadic, much like the refrigerated market. So anybody feeling that pain, you understand why I make the grimace look. But when you look at this, it's very sporadic. You'll see the holiday dips and increases, but we're following that trail perfectly. Now you look at the spot rates, we're cresting, going to hit a market draw, a flat line, as you will, and then with a dip and increase. And finally, the big one, flatbed spot loads, we are falling, and we are following that trend, which typically does happen. So everybody ramps up into the springtime, and then you tail off, get a little bit of bump in the summer, but then you tail off towards the end of the year. So we're really looking around towards this portion of what's going to happen specifically in here. And flatbed rates, very, very flat, always consistent. We are seeing an uptick, though, over the last week after the 5-week downturn. And the large economic factors, the big one here, wholesale inventory-to-sales ratio. This is a big one because if this does crest over and decrease, that's a good thing. Down is good for this. This means that wholesalers are understanding their inventories, they're selling quicker, and they're turning it over. So the higher ratios that you have for wholesale inventories, that means it's very complex, it's very misunderstood and confusing. So once this dips down, if we can get lower than the 2019 levels, then I'd say we're in a good position. Let me know your commentary below. Do you like this chart? Do you like this look? Do you like the information?